Welcome to the Opening Bell Report.
You open up your brokerage account and you pull up the ticker symbol SLV, the iShares Silver Trust.
Right, a very common move.
Exactly. And you're a diligent investor, so you start looking for the classic markers of a fundamentally strong investment. You're scanning the screen for a low PE ratio.
Or strong quarter-over-quarter revenue growth.
Right. You want to see some robust free cash flow, which, just as a quick refresher, is just the actual cash a business generates after paying all its bills.
Essential stuff for stock picking.
But as you scroll through the data on SLV, you just see blanks.
Blanks and zeros.
There's empty spaces where the most important numbers should be. And it leaves you wondering, is this asset broken? Is there a glitch in my app?
It's a very disorienting experience, honestly, especially for anyone who's been trained to look at the market through a traditional lens.
Yeah, panic kind of sets in.
Naturally. But the good news is the asset isn't broken. It's totally normal to look for a PE ratio or cash flow metrics.
Yeah.
That's what we're all taught to do.
Right.
But applying portrait metrics to a commodity trust is kind of like, well, it's like trying to measure the horsepower of a bicycle.
A bicycle doesn't have a motor.
Exactly. It's simply the wrong unit of measurement.
That makes me feel a lot better about being so confused the first time I looked at it.
Okay.
And really, that brings us to the mission of today's deep dive.
We've got a great analysis report today.
We do. We are looking at an incredibly fascinating analysis report that explains exactly why treating silver like a standard tech stock leads to a phantom analysis.
A phantom analysis, yeah. You're looking for things that aren't there.
So our goal today is to help you completely rewire how you evaluate commodity trusts. We're going to flip your perspective entirely, moving away from microeconomic Wall Street metrics and zooming out to macroeconomic global trends.
Which is a huge shift. But to do that, we have to start at the absolute foundation.
Let's do it. What's the foundation?
Well, to truly grasp the insights from the analysis report, you have to first understand the underlying structure of SLV itself.
Okay.
The critical mistake investors make is applying corporate fundamental analysis to a physical commodity trust. You have to realize that SLV is not an operating business.
Not a business at all.
Right. It does not hire employees. It does not manufacture products. It certainly doesn't sell software or services.
Okay, let's unpack this, because this is where the traditional corporate playbook gets thrown completely out the window.
Out the window.
Let's contrast SLV with those massive companies we all know, like an Apple or a Microsoft. When we look at those tech giants, we measure their value by how efficiently they generate profit.
They build a phone, they sell it, we track the margins.
Exactly. But we are talking about a completely different beast here. When you strip away the digital interface of your brokerage app, SLV is what's known as a grantor trust.
Yeah.
So what you are really looking at is just a massive pile of heavy physical silver bullion.
Just a giant pile of metal.
Yeah. And this physical metal is securely vaulted, primarily over in London.
That vault imagery is crucial. It really grounds the abstraction of the stock market in physical reality.
It makes it tangible.
Exactly. The entire function of this grantor trust is simply to provide investors a way to gain exposure to the price of silver without the logistical nightmares.
Right, because think about the alternative.
If you wanted this exposure on your own, you would have to source the metal, buy it, figure out how to transport heavy pallets of it.
Which is incredibly heavy.
Very heavy. Then insure it and secure it in a specialized vault yourself.
Which just sounds incredibly expensive and complicated for the average person.
It is entirely impractical. So because of that structural convenience, the value of an SLV share is incredibly straightforward. It is entirely tethered to the spot price of physical silver minus the fund's operating expenses.
That is the entire equation.
That's it. So let's walk through those metrics that were showing up as blanks and zeros on your screen earlier.
Yeah, let's start with the PE ratio.
SLV has no earnings. A block of silver does not compound capital. It does not go out and invest in research and development to make a better block of silver next year.
It just sits there.
It just sits there. It does not pay out dividends to shareholders. Therefore, its PE ratio is functionally zero.
That explains the first blank. What about cash flow?
The trust generates absolutely no operating cash flow. There are no operations to speak of beyond holding the metal in a dark room.
A dark room in London. And what about sales growth? That's always the big one investors look for, quarter-over-quarter sales growth.
Again, there are no corporate sales. The trust doesn't have a sales team pitching clients.
So how does it grow?
The trust only expands or contracts its physical holdings based on creation and redemption demand from authorized participants.
Wait, let me stop you there.
Sure.
Authorized participants sounds like deep Wall Street plumbing. Let's translate that for the listener. What does that actually mean in plain English?
Fair point. Think of authorized participants as Wall Street wholesalers.
Wholesalers. Got it.
Yeah. If there is a sudden massive demand from regular investors wanting to buy shares of SLV, these wholesalers go out into the global market, buy actual physical silver, handed over to the trust, and in exchange, new shares of SLV are created to meet that investor demand.
Oh, I see.
And if demand falls and people are selling SLV, the process works in reverse. Shares are destroyed, and the physical metal is returned to the wholesalers.
But that mechanical expansion and contraction is fundamentally different from a company increasing its product sales to consumers.
Exactly.
That makes perfect sense. So if you are building an investment thesis on the PE ratio or the sales growth of SLV, you are quite literally analyzing a ghost.
A phantom.
It doesn't exist.
Yeah.
So what does this all mean? If those traditional metrics are completely useless, how in the world do you value this thing? How do you predict its price action if you can't look at its cash flow?
This is the crux of the analysis report. If you cannot use microeconomic corporate metrics, you must pivot.
Pivot to what?
You have to pivot to macroeconomic commodity analysis. You stop looking at the company, because there is no company, and you start looking at the world.
Okay, here's where it gets really interesting. The analysis outlines the exact macroeconomic metrics that actually matter for silver.
Right.
And the first one is the supply and demand deficit. Instead of looking at corporate sales growth, you have to look at the global demand for the physical metal itself.
And the demand side is staggering.
It is. There was a massive aha moment for me in the report regarding demand. We always think of silver in historical terms, coins, jewelry, maybe silverware.
The old school stuff.
Exactly. But silver has undergone a profound transition into a critical industrial technology component.
The scale of this transition really cannot be overstated. When we look at the demand side of the macroeconomic picture, we're looking at explosive growth in several massive forward-looking sectors.
Like what?
We are talking about AI data centers, advanced semiconductors, solar panels, and electric vehicles.
Let's hover on electric vehicles for a second, because I think a lot of people underestimate this. Why does an EV need so much more silver than a standard gas-powered car?
It comes down to basic chemistry. Silver is one of the most electrically and thermally conductive elements on Earth.
Right.
A standard internal combustion engine vehicle uses a very small amount of silver for basic electrical contacts. But an electric vehicle is essentially a massive rolling computer.
That's a great way to put it.
You have complex battery management systems that monitor thousands of individual power cells simultaneously. You have regenerative braking systems, autonomous driving sensors, and massive electrical loads traveling throughout the chassis.
And all of that needs silver.
All of those systems require highly conductive pastes and components to function safely and efficiently without overheating.
So as the global fleet transitions to electric, the sheer volume of silver required per vehicle skyrockets. And that same logic applies to AI data centers, right? Processing massive language models generates intense heat and requires peak electrical efficiency, which demands more silver.
Yes. So if we connect this to the bigger picture, the supply side is where the macroeconomic tension really builds to a boiling point.
The boiling point.
The analysis report reveals that the global silver market has been in a structural deficit for 6 consecutive years.
6 consecutive years. That is a massive amount of time for the entire globe to be running at a deficit. How does that even happen?
It happens because global mining output is simply failing to keep pace with this surging industrial consumption.
We just can't dig it out fast enough.
Exactly. Every single year for the last 6 years, the world's technology and manufacturing sectors have consumed more physical silver than the global mining industry has pulled out of the ground.
So if we are using more than we are digging up, where is the extra silver coming from to build all these solar panels and EVs?
That deficit has to be made up from existing above-ground stockpiles.
The vault.
Vaults are slowly being drained to cover the shortfall. So when you have explosive, futuristic tech demand crashing headfirst into a multi-year structural supply deficit, that is the macroeconomic metric you use to evaluate silver.
Wow.
You value the global scarcity of the asset against the global necessity of the asset.
That is a total paradigm shift. But supply and demand isn't the only macro factor at play here, right?
It is not.
The report also dives into macroeconomic catalysts, broader economic forces that trigger price movements, and a big one is interest rates.
Yes, silver is highly sensitive to monetary policy. This is where its history as a monetary metal intersects with its current reality. And you have to remember, as we discussed earlier, silver yields exactly 0%.
Let me pause you there because that brings up a really counterintuitive point.
Go ahead.
If it pays literally 0%, why would anyone park their capital in it when a standard treasury bond or even a high-yield savings account is paying 4 or 5%? That seems like a terrible trade-off for an investor.
You've just perfectly described the concept of opportunity cost.
Right.
When interest rates are high, holding a zero-yield rock carries a high opportunity cost. You are giving up that guaranteed 4 or 5% yield. Because of that, silver constantly competes for investment capital with yielding assets.
But the dynamic flips when the Federal Reserve stepped in to change monetary policy.
Precisely. When the Federal Reserve cuts interest rates, The yield on those competing safe assets drops. Suddenly, the opportunity cost of holding silver drops along with it.
So it's relative.
Very relative. Holding a physical asset with a 0% yield doesn't look like such a severe penalty when the alternative is a bond yielding only 1 or 2%.
Ah, I see.
This shift in monetary policy often drives the price of silver higher as capital flows back into the metal.
And that ties into another major catalyst from the report, inflation.
Absolutely.
When the Fed is cutting rates or expanding the money supply, we often see inflation rise. Historically, as fiat currencies like the dollar or the euro lose their purchasing power, hard assets act as a crucial store of value.
And it doesn't get much harder than vaulted physical bullion.
Right, so you have this fascinating dual identity. On one hand, the price is driven by hyper-modern tech demand from EVs and AI.
And on the other hand, it's driven by ancient monetary instincts to hold a hard asset when paper money loses value.
It is a profoundly unique macroeconomic profile.
It really is.
But there is one more piece to the puzzle of analyzing SLV specifically. We established that we can't use corporate efficiency metrics like profit margins or revenue growth, but the report says there is an efficiency metric we can use for an exchange-traded fund.
Yes, the expense ratio.
Which brings up a really practical question on behalf of the listener. We've established SLV generate absolutely no cash flow. It has zero earnings.
Zero.
But it's a massive operation. It has administrators, expensive vault fees in London, heavy insurance costs. If it generates no cash, how does it actually pay its bills?
The mechanics of it are quite elegant, actually. Since the trust doesn't have a corporate bank account filled with cash from sales, it pays its fees in metal.
In metal.
Yeah. The trust slowly sells off tiny fractional amounts of its physical silver holdings over time to cover those operating expenses.
So it's like a block of cheese in my fridge, and the vault managers are just coming by and shaving off a microscopic slice for their sandwich every year.
That is a surprisingly accurate way to visualize an expense ratio on a physical commodity trust.
Nice.
If you hold 1 share of SLV, the actual amount of fractional silver that share represents very slowly decreases over time as they shave a little off the top to pay the rent for the vault.
Got it.
And the rate at which they do that is the closest thing to an efficiency metric you can track. We measure this through the expense ratio. Currently, SLV charges a 0.50% annual expense ratio.
0.5% a year. So when evaluating SLV, you aren't looking at corporate profit margins. You are looking at that 0.50% to see how efficiently the trust is managing your exposure to the physical metal.
Correct.
Okay, so we've completely thrown out the old playbook. We are looking at global supply deficits, AI demand, Fed interest rates, and the expense ratio.
We've covered a lot of ground.
We have. And now we come to the final section of the analysis report, which is incredibly actionable. It's the ultimate competitor test.
This is where we see how professional traders apply these unique metrics in the real world, and the results are often surprising to retail investors.
Because when you analyze a normal stock, say a retail company, you compare its profit margins and growth to its direct peers in the same sector.
Right.
But with SLV, the data dictates that you compare its structure and its liquidity to its peers. And the most direct competitor out there is the Aberdeen Physical Silver Shares ETF. Ticker symbol SIVR.
2 funds, both holding physical silver, both offering the exact same basic service to investors.
Let's look at the stats for this showdown. We just established that the efficiency metric to watch is the expense ratio. SLV sits at 0.50%.
And SAVR?
SIVR, its competitor, comes in with an expense ratio of just 0.30%.
Okay, so lower.
Using standard surface-level stock analysis, SIVR looks like the clear winner. It is measurably cheaper to hold. You are losing less of your cheese to management fees every year.
What's fascinating here is that despite SIVR being cheaper on paper, professional traders overwhelmingly ignore that lower fee and choose SLV anyway.
Wait, really?
They actively choose the more expensive option.
Why would a professional trader whose entire job is to maximize returns purposely choose to pay higher fees? That feels entirely backward.
It comes down to structure and what the analysis calls an impenetrable liquidity moat.
A liquidity moat. Explain that.
When you are managing massive amounts of institutional capital, getting in and out of a position smoothly is far more critical than saving 0.2% on an annual fee. Let's look at the assets under management, or AUM.
Okay.
SLV boasts roughly $46.9 billion in AUM. SIVR, by contrast, has about $6.6 billion.
46 billion versus 6 billion. That is a staggering difference in sheer mass.
And that mass translates directly into daily trading volume. SLV sees massive daily volume, regularly trading over 100 million shares a day.
Huge.
SIVR sees comparatively low volume, hovering around 5 million shares.
That's a huge drop-off.
Imagine a scenario where a hedge fund needs to offload $50 million in silver exposure during a sudden market dip. If they try to sell that into a market that only trades 5 million shares a day, they will crush the price of the asset against themselves.
Right, there just aren't enough buyers on the other side.
Exactly, it's called slippage. But if they sell it into SLV's 100 million share market, it's just a drop in the ocean. They need the massive liquidity that SLV provides.
That paints a very clear picture. You are paying a slight premium for the privilege of being able to hit the emergency exit button without the door jamming.
Well said.
And the analysis points out one more structural advantage: the options market. SLV has a highly liquid options market, whereas for SIVR it is practically non-existent.
That's a huge factor for pros.
But for anyone who doesn't spend their day on trading floors, what does having a liquid options market actually allow you to do? The report mentions hedging and writing covered calls.
Think of options as financial tools to either protect your investment or generate extra income from it. Hedging is basically buying insurance on your position in case the price crashes.
Okay, makes sense.
Writing a covered call is a bit different. Imagine you own a house and you rent it out to collect income. Writing a covered call on SLV is somewhat similar.
How so?
You hold the physical Silver Trust shares, but you sell someone else the right to buy those shares from you at a higher price later on. In exchange, they pay you a premium right now.
Oh, I see.
It's a way for sophisticated investors to generate their own yield on an asset that naturally yields 0%. But you can only execute those strategies if there are enough buyers and sellers in the options market,
which SLV has.
and SLVR does not.
So that impenetrable moat of liquidity and optionality is the deciding factor. It proves that in the commodity trust space, structural utility outweighs a slightly better efficiency metric.
Without a doubt.
Which brings us to the big takeaway of this entire deep dive. If you want to understand SLV, you have to let go of the traditional Wall Street playbook.
Throw it out.
When you buy a share of SLV, you have to remind yourself, I am not buying cash flows. I am not buying an innovative management team.
You're buying a rock.
You are buying a scarce, vital tech commodity that is currently caught in a multi-year global supply squeeze. You are buying the macro reality, not the micro fundamentals.
And that raises an important question based on everything we've unpacked today. I really want you to consider this.
What's that?
If silver is no longer just a historical monetary hedge, but has truly evolved into a critical tech commodity, and if it's been in a structural mining deficit for 6 straight years, while demand only accelerates, what happens to the future of the global technology supply chain?
From the AI data centers to the EV market.
Exactly. What happens if the physical Earth simply cannot yield enough silver to meet our technological ambitions?
Man, that is a massive and heavy question to ponder, and it entirely changes how you look at that 3-letter ticker symbol on your screen.
It really does.
Thank you for joining us on this deep dive. We hope this helps you look past the blanks and zeros, understand the true mechanics of the commodity market, and keep asking the right questions.
Keep digging.
Until next time.
Don't forget to like, share, and subscribe for more.